oil markets have been pushed and pulled around in recent days and weeks on the worries about global oil supply reaching the world's market. When Hamas invaded Israel, oil markets gapped sharply higher in speculation and concern that perhaps Iran would enter the conflict and maybe oil would not be able to get to the world's markets. That caused oil prices to move sharply higher. However, as the prospect of a truce and a ceasefire began to grow, oil markets began to de-risk some of that risk premium in oil markets as the prospect of Iranian intervention became less and less likely. Then we've seen oil move sharply lower. Now, recently, there's been a little bit of upside in oil on speculation that the next OPEC plus production cut, originally scheduled for this weekend, now postponed to November the 30th, that would see maybe another production cut announcement from Saudi Arabia. However, the latest concern is that Nigeria and Angola are having to accept a new baseline that reflects their actual production capabilities. And so there's been a delay to the meeting as Saudi Arabia and the other members try to reach some kind of agreement. Now, what do the seasonals tell us about this time of the year? If you look at the pattern, we see that WTI crude sees apparent weakness at this time of the year from now until the sort of December the 10th. So if we don't see production levels agreed, will oil continue its slide in line with a seasonal outlook? It's certainly something worth looking at. The major trade risk, of course, all outlooks have risks. This is no exception. The major obvious risk here is from the OPEC plus production meeting. If it goes ahead or it's brought forward earlier and Saudi Arabia increase their production cuts, that could lift oil prices in the meantime as the group tries to address oil's recent slides. Remember, don't just trade it, season exit.